Today, we're going to talk about the dead cat bounce. So what exactly is a dead cat bounce? In short, it is a temporary recovery from a major drop in a stock's price. But since the recovery is unsupported by current fundamentals, it is short-lived and fails to materialize, resulting in the stock moving back lower, continuing in the direction of the downtrend. The term is said to have originated from a fellow by the name of Raymond Devoe Jr. On April 28, 1986, Raymond told the San Jose Mercury News, "If you threw a dead cat off a 50-story building, it might bounce when it hits the sidewalk. But don't confuse that bounce with renewed life. It is still a dead cat." During a severe or prolonged decline in a stock's price, short sellers will look for areas to cover and take profits. Buyers who have been waiting patiently for stocks to move higher will likewise look for areas to buy. When a rally starts to happen, shorts cover their positions at the same time as buyers buy. This results in a temporary thrust in volume, which causes the stock to rally higher. The buying that caused the rally is usually brief and not enough to sustain the upward move, resulting in what looks like a pulse or a bounce before the stock continues to decline. Since the dead cat bounce is fairly difficult for the novice trader to recognize, most traders will try to trade the bounce long. Established traders with more experience in technical analysis will often recognize the bad news, the lack of fundamentals, and the current trend. These traders will purposely miss or refuse to trade the rally higher off of the initial bounce, and instead they will look for areas of resistance to short the stock for the continuation of the downtrend.